Welcome to the deep dive. If you've been keeping an eye on crypto investments, you know these spot ETFs for Bitcoin and Ether. Well, they've really shaken things up for how big institutions get involved.
Oh, absolutely. A game changer. And right now, the data from those funds, it's telling a completely divergent story. We're seeing a very clear rotation of institutional money.
And that's what we're diving into today, trying to cut through the finance speak and really unpack this rotation. We've got sources looking at the money flowing into Bitcoin ETFs versus pulling out of Ether ETFs. The mission is really to figure out the why. What's the thinking behind this split between the two biggest digital assets?
It's striking, isn't it? That contrast is really defining the market this week. You've got one asset getting this huge vote of confidence while the other one's kind of being put on pause.
So understanding that why feels pretty key to understanding institutional sentiment right now.
Exactly. It reveals a lot about risk appetite and their view of the bigger picture.
Okay, let's maybe level set quickly for anyone who hasn't been glued to the charts. These spot ETFs, they're the bridge, right, between traditional finance and crypto.
That's a good way to put it, yeah.
Wbefore we get into the divergence, maybe just a quick reminder, what do these flows actually tell us?
Sure. So a spot ETF, it's basically like a container, a wrapper. It lets the really big players, think pension funds, hedge funds, get exposure to the real-time price of Bitcoin or Ether.
Right, without the hassle of wallets and keys.
Exactly. No custody headaches. So when we talk about flows, we just mean the cash moving in or out of that fund. Positive inflows. That means investors are buying shares. They want more exposure. Simple as that.
And when money leaves, it's not just someone casually selling on an exchange, right?
Yeah.
It's more significant with these ETFs.
That's a key point, yeah. When we talk about outflows here, often we mean redemptions. That's institutions selling their shares back to the company that issued the ETF.
Which forces the fund manager to actually sell the underlying Bitcoin or Ether.
Precisely. To cover those redemptions. So it signals a more formal, maybe strategic decision to reduce their holding. It's not just noise.
And those flows are painting, well, two very different pictures right now. Maybe an analogy would help here. To really grasp the scale of this split before we hit the numbers.
Okay, yeah, I think that could work. Imagine the whole crypto market is like a big concert venue, right? Two main stages, but they're playing one after the other.
Okay.
Right now, you could say Bitcoin is the main headliner, just about to come on stage.
Yeah.
And Ethereum, that was the opening act that just finished its set.
Oh, I see where you're going.
So people are flooding towards the main stage area that's Bitcoin, right? Recording these huge inflows. Everyone's excited for the big show. But a lot of the folks who are right up front for the opener, they're stepping out, maybe grabbing a drink, taking a break. That's Ether, seeing the redemptions, the outflows.
That makes the divergence really clear.
Yeah.
People moving from the opening act stage to the main headliner stage.
Pretty much.
Okay, so let's look at the actual data that backs up this stage swap analogy. How big were these moves recently?
The Bitcoin surge is, well, it's pretty undeniable. Spot Bitcoin ETFs, they pulled in a net $446 million just last week.
Wow, nearly $500 million.
Yeah. And this isn't just, small investors. This signals renewed, pretty robust confidence from institutions. And it wasn't just one day they added another, $90.6 million on Friday alone. The momentum's there.
Meanwhile, Ether, you called it a chill.
Definitely a chill. Spot Ether ETFs, they just finished their second straight week of significant outflows, pulled out $243.9 million this past week.
And that was after another big outflow the week before.
Right. About $311 million the week prior. So you're looking at, over $500 million walking out the door in just 2 weeks. Analysts are literally calling it cooling investor sentiment.
And if you look at the total picture since these ETFs launched,
the preference is even starker.
Right.
Bitcoin's total inflows are now almost $62 billion. That's like nearly 7% of Bitcoin's entire market cap held in these funds.
Okay, wow. And Ether?
Ether's cumulative inflows are much smaller, around $14.35 billion, which is about 5.5% of its market cap. So the depth of conviction, the amount of capital committed long-term, it's just bigger for Bitcoin right now.
And this isn't just abstract market movement. The sources pointed out specific funds, right?
Right.
BlackRock.
Exactly. On Friday, BlackRock's main Ether ETF, ETHA, led the withdrawals, pulled out over $100 million.
Ouch.
But at the same time, BlackRock's Bitcoin ETF, IBIT, was leading the inflows, along with Fidelity's FBTC.
So the same big players moving money out of one crypto product and into the other. That feels very deliberate.
It screams strategic shift, yeah. It's not random noise. And that really brings us to the why. What's driving this? It's more than just general crypto confidence.
Right.
It seems deeply tied to how these big investors are reading the global macroeconomic tea leaves. Vincent Liu from Kronos Research, he didn't just call it a shift, he called it a strong rotation into Bitcoin.
Okay, so why Bitcoin specifically, and why now? What's the thinking driving this focused bet?
It plugs right into Bitcoin's core narrative. Investors are really leaning into that digital gold metaphor.
The store of value idea.
Precisely. When things feel uncertain globally, maybe geopolitical tensions rise, what do people buy? Traditional gold, right? As a
Okay.
safe haven.
Mm-hmm.
Well, big institutional money is increasingly viewing Bitcoin through that same lens. It's scarce, it's outside the traditional system or perceived to be, and it should, in theory, hold value when other things get shaky.
Okay, digital gold makes sense as a safe haven play. But here's something that feels a bit contradictory. Analysts are saying a major driver is actually the anticipation of things like interest rate cuts. Monetary easing.
Right.
Doesn't relying on what the Federal Reserve might do kind of undercut the whole independent digital gold idea if its price depends on central bank actions?
That's a really sharp question. And it's subtle. It doesn't undermine the scarcity aspect. Bitcoin's supply is fixed, regardless of the Fed. But you're right. Its price drivers are definitely linked to macro policy right now.
So how does that work? Why does easier money help Bitcoin?
Well, think about what monetary easing means. Central banks cutting rates, maybe injecting liquidity. It generally aims to make borrowing cheaper and stimulate the economy, but a side effect is it often devalues traditional fiat currencies like the US dollar.
Ah, okay. So if the dollar is expected to be worth less because more are being created or rates are falling.
Investors look for assets that can't be easily created or devalued. They want something non-sovereign, mathematically scarce. And Bitcoin, with its hard cap of 21 million coins, it fits that bill perfectly. It's seen as a hedge against that potential currency devaluation.
So the bet is the Fed will eventually loosen policy that will weaken the dollar relative to hard assets, and Bitcoin is the prime digital hard asset to benefit.
You got it. Big money wants their capital parked in the asset they think benefits most directly when or if that easing environment arrives. So yeah, it's like a safe haven, but one they also expect to get a boost from future monetary policy.
So it's kind of a dual bet then. Stability, like gold, but also potential upside from expected central bank moves.
That seems to be the institutional thinking right now, yeah.
Okay, that clarifies the Bitcoin side. But here's where it gets really interesting for me. If Bitcoin is this confident, macro-driven play, why actively pull money from Ether? Especially given all the excitement earlier this year around ETHA upgrades and potential.
Yeah, the Ether outflows, they definitely signal that cooling demand we talked about. But crucially, analysts point to softer on-chain activity for Ethereum as well.
On-chain activity.
Yeah.
What does that actually mean in simple terms?
It's basically a measure of how much the network is actually being used. Things like the volume of transactions happening, are new decentralized dApps being launched and gaining traction, how much activity is there in decentralized finance, DeFi, which is really Ethereum's bread and butter.
So less stuff is happening on the Ethereum network itself.
Kind of, yeah. Or at least the growth in usage and excitement isn't matching the levels that would justify institutions keeping such large, aggressive positions right now. The engine isn't firing on all cylinders, you could say.
Yeah. So unlike the Bitcoin bet, which is based on the big picture macro forecast,
Right.
the decision on Ether seems more fundamental, based on the current state of the network itself. Institutions are basically saying, show me the activity, show me the utility.
Exactly. They aren't necessarily abandoning ETH forever. They're just waiting for new catalysts before they jump back in aggressively.
Catalysts like what?
Yeah.
What are they looking for?
Could be a few things. Maybe a significant breakthrough in institutional staking where they lock up their Ether to help run the network and earn rewards, or maybe specific technical upgrades, those EIPs, Ethereum improvement proposals, that really boost efficiency or / transaction fees.
Something that makes it cheaper or faster to use.
Yeah, or enables entirely new uses. There's a lot of focus on layer 2 scaling solutions right now, tech built on top of Ethereum to handle more transactions. A big success there could really kick that on-chain activity back into high gear.
So it sounds like Ether had its initial run, maybe based on earlier hype or upgrades, and now it's in a bit of a prove-it phase, waiting for the next big technical leap or wave of adoption.
That's a good way to put it, a prove-it phase. So the expectation is, BTC inflows probably stay pretty strong next week because that macro bet hasn't
Right,
changed.
the rate cut anticipation is still there.
Still there. But Ether, it's likely to stay in this holding pattern, maybe see more outflows, because it lacks that immediate, compelling reason for institutions to load up right now. It needs a new trigger.
Okay, let's quickly recap the main dynamic here. Bitcoin's seeing this confident rotation in, fueled by that digital gold status and, critically, the expectation of favorable macro conditions like rate cuts, while Ether's in a cool down, experiencing outflows. Investors are stepping back due to softer network activity and are basically waiting for new, concrete technological catalysts or a pickup in usage before recommitting capital.
That sums it up nicely. And, this whole situation raises a really interesting question, maybe for you, the listener, to chew on.
Oh, go on.
Well, given how tightly this Bitcoin institutional sentiment seems linked to anticipated monetary easing, what happens if those rate cuts get delayed significantly?
Yeah.
Or maybe they're smaller than expected? Or, what if they don't happen for a while?
Uh, how long can Bitcoin keep this institutional favor if the macro narrative driving it doesn't actually play out as expected?
Exactly. The digital gold story is powerful, but the current inflow momentum seems heavily reliant on that macro prediction coming true. It's definitely something to mull over.
That is a great question to leave everyone with. Really makes you think about the dependencies. Okay, well, if you found this deep dive useful, we'd love it if you'd follow, like, or maybe share the show.
Yeah, helps us out.
And if you want to keep up with more content like this, you can follow What Bitcoin Taught Me on, well, pretty much everywhere. Twitter X, Nostr, Blue Sky, Threads, Instagram, Facebook, LinkedIn, all spots.
We're out there.
Thanks so much for joining us for this deep dive.